Your old neighbor's retirement account is disappearing. And it isn't disappearing because the market is volatile. It's not also disappearing because interest rates are high. Not because some politician made a bad decision. It's disappearing because of a machine that's been running for 2,000 years. And right now, you're inside it. $38.4 trillion. That's the U.S. national debt as of December 2025. That number grows by $6.12 billion every single day. Every hour, $255 million. Every second, over $70,000 added to a debt your children will inherit. And here's the vulnerability stat that should terrify you. Debt is now 121% of GDP. America officially owes more than it produces. I'm going to show you something you won't see on the news. Not because it's secret, but because it's too obvious. The pattern is right there, carved into the ruins of Rome, written in the ashes of the British Empire, and now repeating itself on Wall Street. By the time I'm done, you'll see exactly how this machine works. And more importantly, where we are in the cycle. The choreographed exits. Let me fire some numbers at you that should make your stomach drop. In 2025, tech billionaires sold $16 billion in stock. Jeff Bezos, $5.7 billion. Safra Catz, $2.5 billion. Michael Dell, $2.2 billion. Jensen Huang, $1 billion. These aren't people diversifying portfolios. These are the people who built the machines that run the modern economy, and they're heading for the exits. The Congressional Budget Office just projected debt will hit 134% of GDP by 2035 under current policy. That's higher than World War II. Meanwhile, net interest on the debt crossed $981 billion in October 2025. We're paying almost $1 trillion a year just to service old borrowing. That's more than we spend on defense. Central banks worldwide increased gold purchases to record levels in 2024 to 2025. China, Russia, Turkey, they're not buying Treasury bonds anymore. They're buying the thing that survived every currency collapse in history. The Federal Reserve's balance sheet exploded from $870 billion in 2007 to over $8.9 trillion by 2021. That's not monetary policy. That's a fire sale. Dollar share in global reserves just hit a 2-decade low, under 60%. The world is slowly, methodically, moving away from holding US dollars. These aren't random events. They're choreographed exits. The smart money sees something the rest of us are trained not to see. The 4-stage blueprint. Every collapse follows the same blueprint. I call it the Debt Dominoes. 4 stages, same sequence, different costumes, same corpse. Stage 1, the Golden Age. This is when productivity is king. The empire is competitive, innovative, dominant. Trade flows in. Taxes cover spending. The currency is trusted. People work, save, invest. The public believes prosperity is earned. Insiders know this won't last, so they build infrastructure, secure power, and prepare for stage 2. It feels like Rome in 100 AD when the denarius was almost pure silver. It feels like Britain in 1850 when the pound could buy the world. It feels like America in 1950 when a factory worker could buy a house on one income. Think of it like scissors, both blades sharp, cutting cleanly. Stage 2, the debt trap. Now the empire can borrow cheaply because everyone still trusts the currency. So it does. Wars get expensive. Welfare expands. Infrastructure decays, but nobody wants to pay to fix it. The government prints or borrows to cover the gap. The public thinks this is normal. Deficits are just how things work now. Insiders start moving wealth into hard assets, land, gold, foreign holdings. Rome in 200 AD when emperors started shaving silver from coins to pay soldiers. Britain after World War I with debt at 180% of GDP. America today running trillion-dollar deficits during an expansion. The scissors? One blade dulls while the other keeps cutting. The cut gets messier. Stage 3, the debasement. The empire can't pay its debts in real value anymore, so it pays in fake value. Currency debasement. Inflation. The money people saved for 30 years buys half what it used to. Wages don't keep up. The middle class starts disappearing, not vanishing, just sinking. The public is angry but confused. They blame immigrants, or tech, or the other political party. Insiders are liquidating positions, buying foreign real estate, shifting to assets that can't be printed. Rome by 265 AD, when coins were 0.5% silver and prices skyrocketed 1,000%. Britain in 1976 begging the IMF for a bailout with the pound in free fall. America in 2025 with the dollar down 98% in purchasing power since 1971. It's like poison in the bloodstream. You don't notice it until your legs stop working. Stage 4. The collapse. Confidence breaks. The currency fails. Trade networks freeze. The empire fragments. What took 200 years to build unravels in 20. The public panics. Insiders have already moved their wealth offshore or into assets that survive the chaos. Governments try price controls, capital controls, emergency measures. None of it works because you can't legislate away mathematics. Rome in 476 AD, when the Western Empire simply stopped functioning. Britain in 1947, when it had to grant India independence, not out of virtue, but because it was bankrupt. America? We'll get to that. The proof is in the ruins. Let me take you to Rome, 235 AD. Everyone thinks the crisis started with barbarian invasions. It didn't. It started with the imperial budget. Picture the Roman Forum. Merchants trading, soldiers marching, the Senate debating. Under the surface, the denarius, the coin that built an empire, is rotting. When it was introduced around 211 BC, it was almost pure silver, about 4.2 grams. Trustworthy. Respected. By the time of Emperor Nero in 54 AD, it was 75% silver. By Caracalla, 50%. By Gallienus in 265 AD, it was less than 5% silver. The empire couldn't pay its legions, so it shaved the coins. Soldiers noticed. They demanded more coins. The government minted more coins with even less silver. Prices exploded. By 265 AD, inflation hit 1,000% across the empire. One historian estimated inflation reached 15,000% between 200 AD and Constantine's reforms. Here's the thing nobody tells you. The public had no idea this was happening at first. Coins looked the same. It was only when merchants started weighing them, when soldiers refused to accept them, when people hoarded the old coins and spent the new ones, that the system collapsed. And here's the insider behavior nobody talks about. Wealthy Romans were buying land in Gaul, Spain, North Africa, anywhere outside the direct control of the imperial treasury. They saw the coin debasement and moved their wealth into things that couldn't be debased. The Roman elite didn't go broke when Rome fell. They relocated. The hidden transmission mechanism? Soldiers. When you can't pay your military in real value, they stop fighting for you. They start fighting for whoever pays better. The empire split into 3 separate states during the crisis of the 3rd century. Barbarians invaded because there was nobody left to stop them. The value that evaporated? Incalculable. Entire cities were abandoned. Trade collapsed. The population of Rome itself shrank from over 1 million to maybe 30,000 by the early Middle Ages. Now let's jump forward. Britain, 1815. The Napoleonic Wars just ended. Everyone thinks Britain is victorious, triumphant, the new global superpower. And they're right, but they're also bankrupt. Britain's national debt in 1815, over 200% of GDP. That's more than £1 billion in an economy that wasn't even worth $500 million annually. The empire had borrowed heavily from Dutch and German bankers to fight Napoleon. The pound was trusted, so credit was cheap. Britain took it. But here's what they did next that doomed the empire. Austerity. For 70 years, from 1815 to 1890, the British government ran budget surpluses to pay down the debt. They cut spending on everything, including education. By the late 1800s, Germany had overtaken Britain in technical education. The US had overtaken Britain in industrial output. Britain was still rich, still powerful, but the foundation was cracking. The public believed the empire would last forever. London was the financial capital of the world. The pound was the global reserve currency. British naval power was unmatched. Insiders knew better. By the 1870s, British capital was flowing to America, Argentina, Australia, anywhere with higher returns than a debt-burdened mother country. The Rothschilds, the Barings, the great banking families, they were financing railroads in America, while Britain's own infrastructure aged. Then came World War I. Debt shot to 180% of GDP. Then World War II, 250% of GDP. Britain had to borrow from the United States just to keep the lights on. In 1944, at Bretton Woods, the British delegation led by John Maynard Keynes tried to create a neutral global currency. The US said no. The dollar, backed by gold at $35 an ounce, became the world's reserve. Britain lost the one privilege that had kept it afloat, the ability to borrow in its own currency and export inflation. By 1947, Britain couldn't afford to keep India. Not wouldn't, couldn't. The cost of occupation exceeded the benefit of extraction. Independence wasn't a moral awakening. It was a bankruptcy liquidation. By 1976, Britain was begging the IMF for a £2.3 billion bailout, the largest in IMF history at the time. The pound collapsed. The empire was gone. The transmission mechanism? Reserve currency status. Once the world stopped needing pounds to conduct trade, Britain lost the ability to run deficits without consequences. The debt had to be paid in real value. Britain didn't have it. Insider behavior before the public knew. Wealthy Brits were already moving fortunes into American stocks, Swiss accounts, African diamond mines. They didn't lose money when the pound died. They just weren't holding pounds when it happened. Snap back to today, where we are now. Stage 1 of America's debt cycle happened between 1945 and 1971. We were the most productive economy on earth. The dollar was backed by gold. Trade surpluses. Balanced budgets sometime. The world wanted dollars because dollars were as good as gold. Stage 2 started in 1971 when Nixon closed the gold window. The dollar became pure fiat, backed by nothing but trust. And we started borrowing. Debt to GDP in 1980, 35%. By 2000, 55%. By 2008, 65%. Today, 121%. We are deep in stage 2, tipping into stage 3. Here are 8 current data points that prove it. 1. U.S. debt increases by $6.12 billion per day. That's $2.23 trillion added in the last year alone. 2. Net interest payments hit $981 billion annually. We're paying more in interest than we spend on Medicare. More than defense. 3. Debt to GDP, 121%. We crossed 100% in 2013. We're now at levels only seen during World War II, except we're not at war. We're at Starbucks. 4. Tech billionaires sold $16 billion in stock in 2025. Bezos, Huang, Dell, Zuckerberg. These are the people building the AI economy. And they're cashing out. 5. Central banks are dumping dollars for gold. Dollar share of global reserves, 59%, a 2-decade low. Gold purchases by central banks, record highs. 6. The Fed's balance sheet, $8.9 trillion. In 2007, it was $870 billion. They've printed 10 times their previous existence into the market. 7. CBO projects 134% debt to GDP by 2035 under current policy. And that's if nothing goes wrong. If interest rates stay low, if there's no recession. In July 2025, Congress quietly passed a $5 trillion debt ceiling increase to avoid default. $5 trillion. The conversation lasted 3 days. Then it disappeared. Let me explain this in terms a 15-year-old would understand. Imagine your family makes $100,000 a year. You owe $121,000 on credit cards. And every year, you're spending $106,000 but only making $100,000, so you borrow another $6,000 just to stay afloat. Oh, and the interest on your credit cards just hit $9,000 a year. You're not paying off debt. You're borrowing to pay interest on old debt. That's America. The hidden trigger. Mainstream media is watching inflation, jobs reports, GDP growth, all surface metrics. They're watching the wrong thing. The real trigger is hidden in the derivatives market and Treasury liquidity. The global derivatives market is valued at over $600 trillion notional. These are bets on bets on bets. They work fine when everyone believes the dollar is stable, when Treasury bonds are risk-free, when the U.S. government will always pay its debts. They're like an insurance policy on a house that's not on fire. But here's the thing about derivatives. They're leveraged. A 5% move in the underlying asset can create a 50% profit or a 100% loss. If confidence in U.S. Treasuries drops, if foreign buyers stop showing up to auctions, if yields spike because nobody wants the bonds, the entire derivatives market seizes up. It's like a chain. Each link holds because the next link holds. But if one link breaks, if one major Treasury auction fails, if one sovereign wealth fund dumps $500 billion in Treasuries overnight, the whole chain snaps. Think of it like this. Imagine a dam. The water's been rising for 50 years. Everyone says the dam is fine. Engineers say it can hold. Then one day, a crack appears. A small one, nothing catastrophic. But that crack means the pressure isn't evenly distributed anymore. The stress moves to other parts of the dam. More cracks. Then the whole thing goes. Not because of the crack, because of the pressure that was always there. That's the Treasury market. The pressure is $38 trillion in debt. The crack will be a failed auction, a downgrade, or a geopolitical event that makes holding dollars feel riskier than holding anything else. The domino roadmap. Here's the sequence. 4 dominoes. I can't tell you the exact dates, but I can tell you the order. Domino 1. Auction stress next 6 to 12 months. Treasury auctions start showing weaker demand. Foreign buyers pull back. The Fed has to step in and buy more treasuries directly, which is just monetizing debt. Yields spike. The government has to pay more interest to attract buyers. This accelerates Domino 2. Domino 2. Dollar dump, 12 to 24 months. Countries holding massive dollar reserves, China, Japan, OPEC nations, start diversifying faster. Not a panic sell, but a strategic exit. They don't announce it. They just stop showing up to auctions. The dollar weakens. Import prices rise. Inflation comes back, but this time it's not supply chain stuff. It's currency devaluation. Domino 3. Debt spiral. 24 to 36 months. Higher interest rates mean higher debt payments, which means bigger deficits, which means more borrowing, which means higher rates. The spiral feeds itself. At some point, the government faces a choice, default, or print. They'll print. They always print. Domino 4. Confidence break, 36 to 48 months, but could be faster. The public realizes the dollars in their savings account, their 401k, their paycheck, are worth less every month. Not 2% inflation. 10%, 15%, maybe more. Runs on banks. Runs on money market funds. Capital controls. The government tries to stop the bleeding with emergency measures. It won't work. It never works. The time compression is the terrifying part. What took Rome 200 years could take us 20. Because information moves instantly now. Once confidence breaks, it breaks everywhere at once. This time is different. You've heard it before. This time is different. Every empire says it. Let me kill 3 objections right now. Objection 1, the dollar is the global reserve currency. It can't collapse. So was the British pound. For over a century, the pound was the unquestioned king. Then it wasn't. The transition took 30 years, from 1914 to 1944. The dollar's been losing share for 15 years already. Reserve currency status isn't a permanent shield, it's a delay. And the delay is ending. Objection 2, the government can just print money if things get bad. You're right. They can. Rome did. Britain didn't, but it ran out of things to sell. America will print. But here's the problem. Printing doesn't create value. It destroys it. Every dollar printed dilutes the dollars you already hold. Ask Zimbabwe. In 2008, they issued a $100 trillion note. It couldn't buy a loaf of bread. Objection 3. Technology will save us. AI productivity will grow us out of the debt. Maybe. If productivity grows by 0.5% more per year than expected, debt could only hit 158% of GDP by 2054 instead of 199%. Congratulations, you delayed the inevitable by a decade. And if productivity stays flat and interest rates rise just 3 basis points for every percentage point of debt, we hit 233% of GDP by 2054. At that point, the entire federal budget is interest payments. I'm not telling you what to do. This channel is not a financial advisor. I'm showing you the pattern. But here are 5 steps that create agency. Step 1. Calculate your liquidity ratio. Take your monthly expenses. Multiply by 6. That's your emergency fund. If you don't have it, build it. Fast. Because when confidence breaks, cash in the bank is the only thing that's liquid. Everything else, stocks, bonds, real estate, freezes. Step 2. Stress test your income. What happens if your salary stops growing for 5 years? What if it gets cut 20%? Can you survive? If the answer is no, you need a second income stream. Not advice, just math. Step 3. Hedge against currency debasement. I'm not saying buy gold. I'm saying understand that when currencies fail, people flee to things that can't be printed. Historically, that's been gold, land, and productive assets. If the dollar loses another 50% of its value like it has since 2000, having some of your wealth in things that aren't dollar-denominated might be smart. Step 4. Get access before it disappears. International bank accounts. Foreign currency. Offshore holdings. These aren't illegal. They're not for tax evasion. They're for diversification. Because when capital controls hit, when the government says you can't move money out of the country, it's too late. Step 5. Position for opportunity. Every collapse creates winners. The people who bought land during the Roman collapse became medieval lords. The people who bought U.S. assets when Britain fell became the new rich. Debt crises destroy those holding cash and bonds. They enrich those holding productive assets. If you see the collapse coming, you can position for the rebuild. The trigger is already pulled. I want you to imagine a bullet in mid-flight. It left the barrel in 1971 when Nixon closed the gold window. It's been traveling for 54 years. It hasn't hit yet. But the trajectory is set. The target is locked in. You can see it if you know where to look. Rome didn't fall in a day. It fell over centuries. But the collapse phase, the part where everyone realized it was over, that took about 50 years. Britain didn't fall in a day. It fell over a century. But the moment of realization, when the pound stopped being the world's currency, happened in a single conference room in 1944. America won't fall in a day either. But the moment of realization is coming. And when it does, it'll feel sudden, because you'll have been trained not to see it. The media will call it a correction. Politicians will call it a temporary disruption. Economists will call it an adjustment. It's not. It's the collapse. And it follows the same pattern it always has. The gun was loaded in 1971. The bullet left the chamber in 2008, and right now we're in the microsecond before impact. If this video just showed you something you hadn't seen before, if you just realized the pattern for the first time, you need to subscribe, because part 2 is coming. And in part 2, I'm going to show you the exact playbook the top 1% are using right now. Not theory, specific strategies. Specific assets, the things they're not talking about on CNBC. Click subscribe. You don't want to be late to this. I'm Malcolm, and this is History Meets Economics. If you think this documentary is wrong, explain where. If you think it's right, explain. Here's another moment where history met economics.